Hello, traders. This is Blake Morrow with Trader Summit. And with me today, I have in the right corner, Mr. Michael Brown from Pepperstone. And in the left corner, we have Mr. Richard Matthews from One.io here to break down everything that's happening in the markets. How you guys doing? I tried to be an announcer.
I was going to say, Blake, I'm very well, but I'd stick to the day job if I were you.
Yeah,
Thanks.
I think so.
Yeah, I'll do that. All right. So anyway, good to see you guys. And what a time to be in the markets. I have to say, obviously, the markets have been rattled this week with what's happening in Israel and with Hamas and everything there. And I have to start there, not because I want to, but I think it's important to kind of start with that topic, as dire as it is. What do you guys think? I don't need to, us to go into a conversation on what do you think about what's happening over there, but what do you think the market's response has been, and what you've seen thus far? And let's start with you, Richard. Being that you've been around the block a few times, explain to us.
That's a nice way of saying you're right.
I'm trying to be nice here.
Coming out already.
Yeah. But Richard, let's start with your experience. How about that?
Right. Okay. So last week was my 50th anniversary of starting broking in the city. And this, funnily enough, takes me back to 1973, which is the year that I started when I had a full head of hair. And the oil price shock, which was around about 73, caused massive inflation. I think the market's response has been amazingly muted. And maybe they're right, they're just pausing, stepping back, waiting to see what unfolds. I think there's a real danger that it escalates, gets out of control. I think Hamas may have put its proverbial in a hornet's nest and it's going to get nastily stung. I think there's a danger that does escalate and oil goes through the roof and you get an oil price shock and whoa, we got inflation back here again. And that's my concern. I am a little bit puzzled by how relaxed the markets are.
Yeah, I'm not. Firstly, we should all acknowledge what a horrific sequence of events it is, and the human element of it. It is tragic, as you rightly say. I mean, it sounds almost slightly callous to be talking about the markets, but that is what we must do. I think the market moves kind of makes sense. Obviously we had that knee-jerk haven bid on Sunday night here and on the Monday morning open, oil popping higher, gold higher, equities lower. I think actually the fact that you guys had Monday off for Columbus Day might have limited some of the reaction, because we weren't getting that steer from treasuries that you would normally get. No one really had a clue what the bond market was thinking. But if you think what's happened since then, since this all kind of erupted over the weekend, there hasn't yet, touch wood, been a major escalation in the situation. There haven't been other regional players being dragged in. I think crude is still underpinned by the risk that may happen, because Israel itself is not a big crude producer. I don't think it produces really any oil. That's more the risk of, do Iran get involved? Do we have issues in the Strait of Hormuz, et cetera, et cetera? So I can understand why oil remains relatively underpinned. But actually, I think the moves that you're seeing elsewhere, and I'm sure we'll get onto this as the conversation goes on, the fact that gold is still higher, the fact that treasuries have rallied, and the fact that equities have come nicely higher as well, I don't think that is a reflection of geopolitics. I think that's more a reflection of what the Fed have been saying. I think unless and until we see any escalation or spread of conflict, I think the market, outside of assets in that region and outside of a greater risk premium being put on top of crude oil, I think the market can probably take that in its stride.
It's I think you're 100% succinct in saying that, hey, we as much as we don't want to talk about this because of the horrific nature of this situation, we do have to talk about the market response here or in some cases lack thereof. But Richard, let me ask you, based on your experience and in situations like this, where do investors go? Because when you have conflicts, major conflicts, and let's say it starts to unravel and maybe get a little bit more intense, where do investors go? Do they go to gold? Do they start buying oil in this case because of the situation you guys outlined? What do you guys think here?
I guess traditionally you buy gold. I never really quite understand the logic behind it. You can't eat the bloody stuff, can you? Can't even,
well, yeah, we can throw it at each other, or maybe send it by snail mail, right?
I guess you buy gold. Bitcoin's actually holding up pretty well as well, which I'm duty bound to say now that I'm a crypto expert. I'd buy gold. I think it will escalate. That's why sadly will escalate. That's probably why I'd be a buyer of oil as well.
All right, Michael, it's you bring up some points about the bond market, and right now a lot of people believe that yields have peaked, but we saw producer prices come in today, and that has maybe tilted the scale a little bit. Let's hear what your thoughts are. A, let's start with the bond market, but B, and then we'll go to you, Richard. And let's talk about what your expectations for consumer prices are tomorrow.
Yeah, of course. I mean, I think the PPI print's interesting. I'll get onto that in a second. But in terms of a broader point on treasuries, I think it's really interesting that we've had 3 very important Fed speeches over the last 3 days. And for me to say that a Fed speech is important when I hate a lot of them, I think says quite a lot. So we heard from Daly, we heard from Logan, we heard from Jefferson earlier on in this week. And they were all talking about how when they're setting policy going forwards, they need to take into account higher treasury yields, particularly at the long end of the curve, and the subsequent tightening in financial conditions that they have caused. Now, for me, 3 Fed speakers don't say pretty much the same thing by accident. That sounds like a coordinated message that's coming from the Fed. And even Chris Waller, one of probably the most hawkish member of the committee, didn't go quite as far as that, but he was also echoing similar thoughts earlier on today. It's Wednesday when we're filming this, saying that actually yields are doing some of the Fed's job for them. So it's no surprise we've had this big dovish repricing. I think we've got something like 3 bips priced for November now. So the market is saying the Fed are done. I think they probably are. I think the balance of risks points towards them having finished the tightening cycle. And I do think there is value in buying the long end at this point, particularly if you expect growth to slow into 2024. But can we say for definite that yields have peaked? Absolutely not. Those inflation risks that Dick rightly highlighted earlier, the labor market is still incredibly tight. I mean, 336,000 jobs added in September.
Yeah.
That's a crazy number for a late cycle economy. So I think, yes, the Fed probably are done. And yes, yields probably have peaked. I think it's quite telling that they paired losses after that PPI number very, very quickly today. But am I particularly confident about that? Not really. We were talking before we started about how we've all got a bit of a lack of conviction about markets at the moment. And, I've certainly got a lack of conviction behind that bond call.
All right. Well, let's discuss tomorrow's CPI. I mean, obviously the market's been waiting for CPI and for this data to come out. Has today's release of PPI changed your ideas about inflation near term? Richard, what do you think?
Oh my God, the lights are gone.
You guys, did you want me to change your voices? Because the profile.
Very smooth.
Someone put 50p in
I haven't paid the electricity bill. Boy, it's bad. Times are real tough over here.
My name isn't really Dick Matthews. Just joking. All right, guys. At least we can all have fun.
Thank God for that.
No, that was funny. All right, let's continue on with your thoughts here.
Inflation. I will say before I talk about inflation, I just wonder whether the Fed has seen something in the banking system that they don't like being caused by high bond yields. I've said this before. I'll say it again. I think there's a nasty surprise in the woodshed lurking. I said it a few weeks back.
You did, actually.
I also said, I think last week, I thought yields had gone too far too quickly and actually you probably should sell the dollar and buy bonds.
Right, he'll end his victory lap.
I'll end I'll just dance around the desk when the lights go out. That's why they went out. I guess you look at that PPI number and you think you're going to get a CPI number at the higher end of expectations. Logically, I think with the Fed talking the way they're talking, it's going to be a really high number to change the market. However, I'll say it again, I think we're going to get trampling inflation. I think it's coming back, and I don't think you've seen the peak of interest rates yet.
That's nice and cheerful, isn't it?
Yeah.
I know.
You asked me a question, you've got an answer. You don't like the answer, it's my problem.
I almost thought he was going to do a mic drop there. All right.
It
So
that way, didn't it?
Michael, what are your thoughts here on CPI?
Yeah, I mean, I'm not 100% convinced that PPI is a great leading indicator for CPI. I mean, usually we get them the other way around. So, that is worth bearing in mind. I think, as Dick rightly said, logically you would say that points towards upside risks. I think when I looked at Bloomy earlier, consensus was in at 3.6, prior was 3.7. 3.7, 3.8 is probably where you'd be pinning that now. But, when we're talking about inflation that's still double the Fed's target, is a couple of percentage points a big deal? Probably not, especially when, we've got Fed speakers left, right and centre sounding arguably as dovish and as cautious as they have this cycle, perhaps outside of the Silicon Valley Bank collapse in March, which feels a lifetime ago. So I think you're right. I think actually it's probably going to be a case of, if we do get a hot CPI number, and that does see downside in bonds, if it does see downside in equities, I think they're probably moves that the market would look to fade relatively quickly, as we saw with the producer prices today.
And the non-farm last week.
Yeah.
Actually, arguably, I think non-farm, and I know Michael's not a big fan of non-farm, but I think it's increasingly important, the unemployment rate, and it was ignored.
Yeah, it was.
Yeah, well, it's interesting because everybody's looking at the headline number, right? But I want to leave with this, and let's talk a little bit about inflation. More importantly, let's talk about the consumer globally, where people have lost a lot of money over the years betting against the American consumer. I remember, and I have a story that I like to tell during the great financial crisis, when the housing market imploded, and I was at my 20-year high school reunion, and I was in a place that was devastated by home prices, and we were outside of a mall, and I saw people running out the iPhone store carrying new iPhones, and I'm like, wow, buying new iPhones. I'm like, what are these people doing? These people can't even pay their mortgages, but they're saving money not paying their mortgages, buying a new iPhone, and that is a really good picture of what the American consumer is like. But at some point, you run out of money and you max out your credit cards, and you just have nowhere else to go. But I want to ask you, when does the consumer, and we can talk American consumer, we can talk about British consumer, UK consumer, global consumer, where do they buckle in this environment? So let's start with you, Michael, and let's go there.
Oh, thanks for throwing me the easy questions, Blake. Blimey.
I'm going to go.
Basically, turn the lights on.
I'm going to go put some money in the electricity meter.
Oh, bloody hell. No, it is a good point you make. I'm very much with you in terms of the never bet against the US consumer. You look at some of the equity names in the US that have done really, really well over a number of years. Pepsi, McDonald's, Walmart, these firms, they survive on consumer spending, basically. And that has proved resilient over time. Is it something that can go up in a straight line forever? No, clearly. I think the big risk to consumer spending, not just in the US, actually, probably worldwide, would be if we do get another bout of inflation. I know Dick has talked at length about this trampoline idea, where you get 3 peaks over the course of a decade, and if we get an oil price shock, we're going to be well on our way to that. And I think if we do get another peak in inflation, that will obviously see prices surge. Cost of living crisis will come back again if it's gone away. But it would hit at a time when savings levels are pretty much where they were pre-COVID. So COVID, no one could spend. They saved up a load of money. They threw it in the bank, or they put it in their back pocket. Those savings have been steadily drawn down over the last 2 years as prices have risen, and they're pretty much back to where they were now on aggregate. On aggregate. So if another cost of living crisis comes around and a big shock to prices, people probably won't be able to cope with it as well as they have done previously. But in terms of other consumer metrics, I mean, labor markets are still pretty tight. Earnings growth is healthy enough globally. I mean, I'm not seeing any massive red flags in terms of consumer spending, maybe outside of China, where demand is still pretty weak. I mean, we had LVMH results out yesterday, Tuesday, and they were pretty poor. So clearly, there's some demand deterioration in the luxury sector, but by and large, I think that never bet against the US consumer line still holds true.
All right, and Richard, do you have any thoughts regarding that? I know you wanted to disappear into the restroom, but we're gonna hold your feet to the fire here.
Well, having spent a week in the south of France the week before last, I can't believe the French retail sales are going to be down. I'll give you a clue. My bank balance is down. Definitely. I think there are the first signs of people tightening their belts over here. There was actually a tweet yesterday, wasn't there, about restaurant spending going down as people tighten their belts. Yes, I made the comment that restaurants make me that my belt's tightening because I'm eating in restaurants too much. So I think that there are a few signs coming out over here, but the American consumer just carries on. It just seems to be absolutely regardless. I think we're a very different country, and I think people are expecting the government to help them out with higher energy costs this winter, and the government hasn't got the money to do that. And higher mortgage costs are gradually seeping through as people's mortgages roll off. So I think here we are going to, and probably Europe as well, we're going to face quite a tough winter in terms of consumer spending. And the States, I think, will carry on regardless.
Well, that's the big difference. Sorry to jump in, Blake.
No, please do.
You guys in the States don't have the mortgage issue we're going to have. From my understanding, from 4,000 miles away, the issue obviously we have is fixed rate mortgages rolling off and rates tripling or quadrupling from where they were fixed 2 or 5 years ago. The issue I think you guys are going to have with your housing market, and by all means feel free to correct me if I'm wrong, is that there's a real risk everything just seizes up, not because mortgage rates are going through the roof, but because no one wants to get rid of their 30-year fix at 3% and move to a new one at 7%, which they'd have to do if they moved house. So I think housing's probably on shaky ground on both sides of the Atlantic, but for very different reasons.
Yeah, and really, I think that boils down to jobs, right? I mean, it's the labor market. I like give you a personal example. I'm not a real estate investor, but and I've very much have told our community that's just not my wheelhouse. But yeah, I mean, my mortgage is 2.5%. It's like, and I know plenty of people around me that are in the same boat, and those people aren't going to move unless they lose their job. They lose their job, and they're forced to move. That's just really going to be where our housing market is at. And you're right, it's kind of frozen now. And incentives can only take you so far in this environment when rates are at 7 or your mortgage rates are 7-8%. So they can only buy down so much. So yeah, and you're not alone in the UK. There are other countries, obviously like Australia, for example, or some of our friends over there dealing with the same issues. So it's going to be a really interesting time moving forward, I guess, when you talk about the consumer, the housing market, and really what it boils down to is where's the least dirty shirt in the hamper? I know we use that analogy a lot, but I want to leave with this, guys. You are at the Trader Summit, so let's start with you, Richard. Where's your trade? The dollar's been pulling back. I mean, is the dollar done? Do you start buying dollars here? What do you do? What's your trade? Where's your head at?
I think we spoke last week and the week before, and I was going a bit twitchy. Dollars and get out, get flat. I'd actually be tempted to buy dollars now.
Okay, well, there
dollars.
you go.
And I might tickle actually some Swissy in as well, just on risk aversion.
Whoa! All right, well, Mr. Brown, how about yourself, sir?
Well, I'm sort of mechanically long Swissy because I'm going there next week, but that's not a speculative trade. I would be...
I'll see your bank account.
I wish. Someone else's. I would be buying the dip in the dollar. I think it is that cleanest dirty shirt that you said. I think if we do get another sell-off in treasuries, then you really start to look at buying the long end, 10s and 30s. Equities, I've got very little conviction, but if the S&P can get above its 100-day moving average, which I think is about 44.10, I'm miles away from a chart, then I'd probably be looking to get long equities if we can close above there. So there you go, 3 trades for the price of 1, Blake.
Woo! We love that here at the Traders Summit. You know, gents, I know we try to do this at least once a month, and I love it. And I love that you two are together and are meeting.
But not together. You could rephrase that. Actually,
I'll tell you,
a married man.
I'll tell you, Richard, you will not be at the pub when Michael visits the pub. How about that?
That's true.
So,
that's
gentlemen,
exactly where we're going.
What's the best way for us to follow you out of the pub and into your work?
You follow me at Dickie Matthews on Twitter and 1.io on LinkedIn. It's the best way.
Well, certainly don't follow me out the pub. God knows where we'd end up.
It's true.
Mr. M. Brown on Twitter, Pepperstone, TraderX, everywhere else.
Great. Well, thank you, gentlemen, for being here with us here at the Trader Summit. I love having these conversations with you. You both are two top shelf individuals. So thank you so much. And if you like what you heard here, make sure you give them a big thumbs up, subscribe to the channel down below. And thank you, gentlemen. We'll catch you hopefully in a couple of weeks.
Cheers, Blake.
Cheers, bye-bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.